Welcome back to City Education, your home for education in all forms, shapes, and sizes. Today we are moving back to finances. We'll be conducting an introduction to the books of prime entry. Now, every financial story begins with evidence. In accounting, that evidence is called a source document. A receipt, invoice, bank statement, or voucher be a source document as well. These records are not just paperwork. They are proof that the transaction took place. From here, accountants or legal practitioners alike need a reliable starting point to capture and organize each transaction in chronological order. That starting point is the book of prime entry. Think of it as the first diary entry of your finances, the raw record before anything is analyzed or summarized. Why does this matter, you may ask? Because without a proper book of prime entry, you risk confusion, errors, and even non-compliance with legal requirements. More importantly, it breaks the golden thread of the audit trail, which is the link that allows anyone to trace a transaction from its origin in a receipt, all the way to the final resting place in a ledger account. Books of prime entry are therefore not optional. They are the bridge between raw documents and structured accounts. In legal practice, they safeguard transparency, keep clients' money distinct from business money, and ensure compliance with professional rules. Now, source documents are the DNA of accounting or bookkeeping. They are the original proof that money changed hands. Without them, you cannot justify your entries in the Cashbook or defend your accounts in an audit. Every source document should contain at least 4 essentials: names of parties involved, amount, date,
substance of
section, meaning what exactly happened. Was it a fee, a client deposit, or office expense? But we essentially won't be looking at dates in this section. If any of these are missing, the document becomes weak evidence and your records may be challenged. Now, in legal practice, accuracy is even more critical. Trust documents and business documents must be kept distinct from the moment they are created. A receipt showing client funds belongs in the trust file, while an invoice for rent goes in the business file. Mixing them risks breach of Rule 58.8 of the Legal Practice Act, which requires split separation. Now, a book of prime entry is exactly what the name suggests. It is where we record transactions for the very first time after examining the source document. In most legal practices, the key books of prime entry are cash books because almost every transaction involves moving money in and out. The cash book is structured into 2 columns:
receipts
and payments, basically debits and credits. Now, in the receipts, the debit side, we record money that is received and coming into the account. Now, on the payment side, the credit side, we record money that is paid out and is going out of the account, okay? Now, when money comes in, such as a client paying a transfer fee into the trust account, we record it in the receipt side, the debit
side.
When money goes out, such as a payment to the municipality on a client's behalf, we record it on the payment side, which is the credit side. Now let's look at a simple example where a client, let's call him Mr. Smith, deposits $15,000 into your account, or basically your firm. That money will go into the trust account because it's pending instruction from your client. Now, clients' monies always go into the trust account, while transactional monies that include your salaries, your daily business things should go into the business account. Now let's go back to the client Smith. Now, Mr. Smith deposited the $15,000. You record it in your trust cash book on the debit side, the receive side. In other words, now it's recorded in the receive side. It will need a subsequent ledger in order to be recorded on the credit side because remember, everything that's done on the left is also done on the right.
This will be touched on
extensively in the next video where everything will be in practical form. Now, later on, Client Smith instructs you to pay $5,000 for shares. You will go on to record that on the coded side because Stephen Smith, who already has money in the trust account, has instructed you to buy shares elsewhere. Now, because we're dealing with a double entry system, a subsequent ledger which already exists under Client Smith will need to be updated. You'll go to the debit side of that subsequent ledger and write the money in which Client Smith has instructed you to buy the face with. Another thing to remember is that when A client deposits money into your trust account. You are a debtor to that client. And on the other hand, if you were to provide legal services to a client with an agreement that they would pay you later, such a client is a debtor to the firm. Now, it is important to think of your cashbook as your diary, a day-to-day record in chronological order. The ledger, on the other hand, is like a filing cabinet, neatly organized by the accounts for clarity and reporting. Now, in legal practice, one principle outweighs all others: the golden divide between trust banking account transactions and business banking account transactions. Rule 54.8 of the Legal Practice Act rules
makes this separation
mandatory. Now, why, you may ask? Because trust money never belongs to the firm. It belongs to the client, held in safekeeping until instructions are carried out. Business money, by contract, belongs to the practice. It's the income you earn or the funds you use to pay operating costs. I think we've established this above. The rule is clear. The records of these two categories must be kept entirely distinct.
This means separate
Cashbooks,
separate
ledgers,
and
separate files. Mixing them is not just a bad habit, it's professional misconduct, and it'll raise red flags in an audit. Now, to re-emphasize the importance, trust funds are ring-fenced. They cannot be used to pay salaries, rent, or any other business expenses. If a firm closes down, trust money remains untouched. It belongs to the clients, not the creditors. Business funds, on the other hand, may be used to cover operating expenses, but must never be supplemented with the client's trust money. On simple terms, trust money is sacred. Business money is yours. Never cross the line. Now let's look at the essentials of a trust banking account. The trust banking account is the big bone of a legal practice's financial integrity. Section 86, subsection 1 of the Legal Practice Act requires every practitioner to operate a trust account. Section 86, subsection 2 goes further. It outlines that this account must be opened at a bank. It has a standing arrangement with a legal practitioner's fidelity fund. Why, you may ask? Well, because this ensures that clients' funds are safeguarded by a protective framework, guaranteeing that they cannot be misused or lost if something goes wrong in the firm. Now, payments from a trust account may only be used according to the trust's instructions or where required by law. This ensures that the funds are never spent without authority. Another key safeguard: if the practice faces liquidation, trust money remains protected. It belongs to the client and cannot be touched by the firm's creditors. On that note, it becomes obvious that mismanaging trust accounts is one of the most serious offenses in legal practice. It can result in disciplinary action,
loss of fidelity
fund certificate, and even striking off. Most rules are simple. Client money in, deposit intact. Client money out, only on instructions. Trust funds equals client funds. Deposit promptly, pay only when instructed or as instructed. Now let's look at the essentials of a business banking account. Now, the business banking account is the financial lifeline of the practice itself. Unlike the trust account, this account holds money that legally belongs to the firm. Business money generally comes from, no. 1, fees paid by clients once services are billed. Number 2, reimbursements. For example, when a client repays
disbursements
that the firm has already covered. Finally, are direct settlements of bids owed to the practice. These funds are not subjected to the same restrictions as trust funds. They can be used to keep the practice running. This means that operating expenses such as salaries, rent, utilities, and insurance can be paid from the business's banking account. It can also pay certain disbursements on behalf of a client, but only when the client has not placed funds in the trust for that purpose. One of the biggest compliance risks is mistakenly paying practice expenses directly from the trust account. As established, this is prohibited. Trust and business must remain separate at every stage, from the source document to the cashbook to the ledgers. Remember, the business account sustains the firm, but it must never rely on the client's trust funds to do so. Basically, business account equals firm's engine. Keep it running, keep it clean. stats sample. Now, money enters and leaves the practice in only two ways, cash or EFT. But the rules are not the same for trust and business accounts. Funds received into either account may come as a cash or by EFT, provided that the proper documentation and proof are obtained. This is where FICA compliance comes in. Every client must be identified and verified before you accept funds. That means copies of identification, proof of residence, and ongoing monitoring of unusual transactions. When paying out from the trust account, the rules are strict. Funds must only be paid via EFT directly into the client's account. Cash withdrawals for clients are not permitted. This prevents fraud, protects clients' money, and keeps your practice compliant. By contrast, the business account is more flexible. It can make payments either in cash or by EFT, depending on the firm's internal controls. Basically, every transaction must leave a clear paper trail, proof of where money came from and where money went. Seeker safeguards are not optional. They protect both the client and the practitioner. Remember, money moves fast. Compliance keeps it safe.
It is important to note that the cashbook represents the practice's cash asset. In accounting terms, an asset is a resource controlled by the entity from which the future income benefits are expected to flow. For a law firm, cash, whether in trust or in business, is one of the most important assets to track. Like all asset accounts, the cashbook follows a simple rule.
Assets increase on the debit side and decrease on the credit side. This means that every time money is received, the cashbook entry goes to the debit side. And every time money is paid out, the entry goes to the credit side. This was established in the Introduction to Bookkeeping, the video. Go check it out when you get time. This will be very important to note in our next video. The cashbook captures the inflow and outflow of cash, but it doesn't tell the full story. To complete the double entry principle, each cashbook entry must be posted with the relevant ledger account. This is why we say cashbook equals book of prime entry, ledger equals book of final entry. And here's the critical rule. Entries in the trust cashbook post only to individual trust ledger accounts. Entries in the business close block post only to business ledger accounts. You'll see this in our next session. This preparation preserves the audit trail and keeps trust money ring-fenced from business money. Well, that's it, folks. We've come to the end of our video. Don't forget to like, share, and subscribe. This is City Education, your home for education in all forms, shapes, and sizes.